Forex versus stocks versus crypto versus futures. Which one to trade? So before you place a single trade, there is a decision most people skip. What are you actually trading? Not what looks exciting, not what your friend is doing, not what someone online told you is the best market, because each market is completely different. So there is different rules, different costs, different competition, different reality. This video breaks all of them down, and with full honesty. So let's start with stocks. And if you have your own money and you are starting from zero, this is probably where I would point you. Why? Because when you trade a stock, you are trading one company, one subject. You can study it, you can understand what it does, what it earns, who runs it. The information is public and regulated, available to everyone equally, unless you are Trump. And that is completely different from trading, for example, your USD, where the price is being moved by central banks, hedge funds, geopolitical events, economic reports from multiple countries, and algorithms running 24 hours a day. You are not studying one thing, you are trying to make sense of everything at once. With stocks, you have a real subject, and there is a lot of them, over 5,000 tradable companies on US exchange alone, which means you are not forced to trade Apple or Tesla like everyone else. You can find less crowded setups, less noise, more readable price. Also, stocks are the least correlated market. So when Apple moves, for example, it is not because Tesla moved. Each company has its own story. That matters when you are building a strategy, because you are not constantly fighting the entire market moving against you at the same time. Of course, there is some correlation between sectors, but as a whole, there is the least correlation compared to other markets. And if you look at the most documented successful traders in history, for example, PNF, which is a Japanese trader, Kulamagi, Jesse Livermore, most came from stocks, and that is not a random probability. One more thing, if you are trading US stocks, the PDT rule, the rule that required $25,000 in your account to day trade freely, that rule is gone as of June 2026, so that barrier for small accounts no longer exists. Now we have futures, and futures are contracts that let you trade the price of an asset. For example, indices, commodities, currencies, and even crypto. But you don't own it. Long, you long if you think price goes up, you short if you think it goes down. They trade on regulated centralized exchanges, which means transparent pricing and lower fees than CFDs. We're going to talk about CFDs later. Originally, futures were built for commercial hedging. So, for example, an airline locking in oil prices months in advance, or a farmer securing the price of his harvest to be secured and be ready for any condition or risk. That origin still matters today. And why? As solo traders and retail traders, it means certain futures markets have real participants with real reasons to be at specific prices. So it's not just speculators and algorithms. There is a lot of genuine participants. That is why instrument choice matters more in futures than most people realize. Because everyone trades NQ and ES, the Nasdaq and S&P futures. They are the most promoted, most talked about, most crowded, extreme algorithmic activity, random spikes, a lot of noise. So go where participants is more genuine. For example, crude oil, where energy companies and airlines are hedging real business. You have gold, where institutions and central banks are storing real value. Gold is a little bit risky. You have wheat and corn, where farmers and food producers are locking in real prices. The more genuine the participants, the more price reflects actual supply and demand, rather than pure speculation and randomness. So for short-term trading or the prop firm route, futures are worth understanding. And futures prop firms are more regulated than CFD prop firms. That matters when you are trusting a company with your capital. So now we are going to go with CFDs, which is contracts for difference. So same concept as futures in terms of what you are doing. The difference is where you execute. So futures trade on regulated centralized exchanges. So they are regulated and centralized. CFDs trades directly through a broker, so who is usually the counterparty to your trade. And you need to be careful here with the broker. There is a lot of fake brokers out there and very scammy ones. So that changes the cost structure. CFDs carry a spread on every trade and swap fees on positions held overnight. Those costs add up, especially if you trade frequently or hold positions for multiple days. So, worth knowing, some brokers charge a higher swap on certain nights of the week to account for weekend interest, for example. So check your broker's swap schedule before you hold anything overnight so you don't find some pricey surprises. So CFD prop firms are less regulated than futures prop firms, but they offer static drawdown. So your maximum loss is fixed before you start. That works for a lot of traders. Also, they have no time limit, compared to futures during the evaluation phase. So you can take your time instead of paying every single month. So it's a valid option, just know the cost is going in. Then we have Forex. And I'm going to be straight here. This is probably the first market most beginners get pushed toward. And in my opinion, it is the hardest one to actually learn in. And you need to understand why people are pushing you into Forex. Because most likely going to give you an affiliate link with a scammy broker who will gonna control your trades and make you lose eventually. So here are the numbers. 92% of Forex transactions are executed by algorithmic systems. So retail traders, people like you and me, represents just 5% of total volume. The rest is banks, hedge funds, central banks, institutional trade players, more capital, more information, faster execution than any retail trader will ever have access to. So take, for example, Euro USD. So any given week, that pair is being affected by US jobs data, Federal Reserve decisions, ECB policy, Eurozone inflation, geopolitical events, currency interventions, easily 10 or 20 high-impact news releases per week. So each one capable of moving price instantly in a way that has nothing to do with your chart or your technical analysis. Short term, the spread is eating your profit on every trade. Long term, swap fees are eating your profit every night you hold. And on certain nights, the swap can be significantly higher than usual depending on your broker. Always check before holding a position overnight so you don't find surprises. So people who made consistent money from Forex do exist, but they are the rarest group in this industry. And the ones who did were very specific about what they traded and when. So if you are still drawn to Forex, please just trade Euro USD or USD JPY only, because they have the most liquidity, tightest spreads, most readable price, and please trade London session only. US session has extreme volatility around news, spreads widening, slippage, and Tokyo session has very low volume, price barely moves, and when it does, the spread eats more of your trade than it's worth, especially if you are scalping. So Forex is not impossible, but it is the last market I would go to, not really the first. Then we have crypto. So let's start with something real. Crypto has a bad reputation in a lot of circles. And if you look at why, it is not because the market itself is broken. It is because of what most people actually do in it. They use leverage with zero risk management. Not because leverage is the problem. You can use very high leverage and still be safe if you control how much you risk on each trade. The problem is using leverage with no plan, no stop loss, no understanding of position sizing. They gamble on meme coins because an influencer told them to. They hold something down 90% out of wishful thinking instead of cutting the loss. They buy and hold with no strategy and call it trading. That is purely not trading. That is the wrong approach with money attached. The market did not fail those people. They came in without the right framework. So the actual market, when approached correctly, is a different story entirely. Before anything else, two things beginners confuse constantly, which is spot and perpetuals. Spot means you own the actual asset. You buy Bitcoin, you hold Bitcoin. If price goes up, you make money. Very simple. Perpetuals here, perps, are contracts that track the price of an asset but never expire. So, like futures, you do not own anything. You are speculating on price movement, long or short, with the option to use leverage. This is actually how most serious crypto traders operate. The reason you hear so many people losing everything in crypto is not because perps are dangerous, like I said, it is because they came in using high leverage with no risk management, or they just bought and held with no strategy at all. That is not trading, that is gambling. Perps themselves are a clean and legitimate way to trade when used correctly. So, where do you trade crypto? I'm going a little bit on details here. You have centralized exchange, like Binance and Bybit. They hold your funds, easy to use, liquid, relatively accessible. You are trusting a company with your money, that's your risk. And you have decentralized exchange, DEX, like Hyperliquid and lighter. No middlemen, you control your funds all the time. And what genuinely makes DEX different is not just transparency, it is that the exchange itself cannot manipulate your trade. So, no forced slippage, no exchange front running your order, no artificially widening the spread. So what you see is what you get, that is a real advantage. On order flow, you can access order flow tools on both CEX and DEX. The depth of market large orders where real buying and selling is happening, that information exists across both. And in crypto in general, order flow tools are more accessible and more affordable than any other market. A lot of them are free. That is a genuine edge crypto has over futures and stocks, where professional order flow data can cost hundreds of dollars amounts. So the risk in crypto, it's correlation. So most altcoins move with Bitcoin. Everyone knows that. When Bitcoin drops, almost everything drops with it. That is different from stocks, where each company has its own story and maybe between sectors. So your universe of genuinely uncorrelated opportunities is smaller than it looks in crypto. But fees are acceptable if you are not scalping. You can scalp, but fees will eat a little bit of your position. You can scalp on exchanges that have very low fees like Mexi or Lighter. Volume is real and verifiable, and the freedom of decentralized platforms is unlike anything else in trading, really. Practical note, please, if you are holding significant capital in crypto, use a wallet. Do not leave large amounts on an exchange for a long time. Not your keys, not your coins. So what you should trade? So on a personal account, stocks or crypto. Both have real successful traders. So pick what genuinely interests you more. So because interest is what keeps you consistent long enough to actually build something, and understanding and build your intuition. On the proper route, futures for sure, because they are more regulated, lower fees, cleaner structure, you are more likely to get your payout. Forex last not first. The cost structure, the noise and the competition make it the hardest environment to learn in as a beginner. If you go anyway, please just trade USD or USD London session only. Remember that. And on the question of trading one market or multiple, there is no specific rules. Some traders do stocks and crypto at the same time. Some move from futures to crypto and from crypto to futures, depending on own conditions. What matters is that you are specific enough within what you trade to actually build real knowledge. So jumping between 5 markets randomly is how you stay a beginner forever, but exploring 2 or 3 to find what fits you, your strategy, your schedule, your goals, that is completely fine. The goal is to find what works for you and go deep on it. So once you know what you are trading, everything becomes more focused. So your screen time is one place, your pattern recognition builds faster, your framework adapts to one set of conditions instead of trying to read 3 different markets at once. And that is what the no noise framework and channel is about. It's to remove what does not belong, all the noise, and keep what actually builds something real. So make it simple, make it adaptable, trust your intuition, and manage your risk. The next video goes into how you actually trade, the types of orders, how to enter and exit correctly. So subscribe, leave a comment, and see you in the next time. Thank you.